This past week or so, we've had a significant rise in mortgage rates, and this has been largely due to one report last week, the Consumer Price Index report for March. Well, this is typically the most impactful single report that comes out. I think in this case, the market has overreacted, and I'm going to explain why. Hey everyone, Zach Shaphorst, mortgage loan originator. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe. So last Wednesday was the worst day for mortgage rates in over a year, since October of 2022. And it was on the back of the Consumer Price Index report for March. This report came in 0.1% higher than expected for both core and headline CPI, or which doesn't include food and energy, which the Fed prefers because they feel they have less control over those volatile indexes. So if you've seen any of my videos over the past year talking about the market, you know that a critical component of inflation is the shelter component of inflation. And in March, shelter was unimpressive. It declined 0.11%, which is nothing. We've seen declines of 0.3, 0.4% in the past. However, on both the overall numbers, headline and core, and on the shelter component, these are not unprecedented results. We've seen hotter than expected inflation before by 0.1%. This is not an astronomically higher than expected number, and we've seen only slight declines in shelter. I've been following this very closely over the past year. Shelter has been very closely following the rent index, and there's a number of indexes, but pretty much any rent index, there's a lagging effect because of the methodology of shelter. It's based on past rents because everyone is not renewing their rent every month. It's usually 6 or 12 months. So there's a lagging effect between the offered rent and the CPI shelter index, which factors in rent. However, over the past 12 months, following the decline in rent, shelter has declined. And it hasn't been exactly the same every month, but it is averaged out to about 0.2 to 0.25% declines each month. And if you factor that in, which I'm still assuming it's going to decline at that rate on average, it's not going to be every month, because that's how rent has declined. And rent declined over a 17-month period. It's only been 12 months since we reached the peak of shelter and since it has started to decline. So I'm expecting at least 5 more months of similar declines, and probably longer, because they have not been as steep of a decline as rent. Based on this, I'm still expecting inflation to get within the Fed's target, which the Fed, as of March, not that long ago, they said that they're expecting 2 to 3 rate cuts. The majority of the members of the Fed said 3 rate cuts, and they're expecting PCE core inflation to be down to 2.6% by the end of the year. So really, the only way we're not going to have rate cuts, which it seems like a lot of people are starting to think this, and even the CME group, the market projects a 12% chance there's going to be no rate cuts in 2024. There would have to be basically no more declines in core PCE, which I don't think is at all likely, because shelter is going to continue coming down. And I think especially in the summer months, it's going to start to come down even more rapidly, because that's usually when people adjust their rents, when people will renew or get new places. Right now, the market is expecting most likely a rate pause in July. And I think that until we get more inflation data, I don't really think this month's PCE metric is going to matter that much, because PCE typically follows CPI. So I'm expecting a very flat month for PCE, just like CPI. But May and then June, if we see similarly flat months for shelter, if we see another 2 more months of 0.1% declines, then I'm going to revise my expectations a little bit. But until then, I'm taking this as a market overreaction. I do think that we're going to, no matter what, we're going to have a bumpy road from now until the next CPI report. Even if I'm right and things rebound, certainly mortgage rates will get better at that point. But until then, I'm seeing a lot of pessimism in the market, and I'm expecting that anything but really good news, which for mortgage rates is lower than expected inflation or a slowing of the job market, anything else is going to be treated as negative and cause mortgage rates to rise. I think it bears mentioning that the attack of Iran on Israel, I don't think will directly, at least right now, affect things dramatically. I could see it leading to an increase in energy because of the oil that we get from Iran in the future. That will affect headline CPI and PCE, but that will not affect the core numbers. That's why the Fed, one of the reasons why the Fed is less concerned on the headline numbers and more concerned on the core, because things like war can affect oil prices dramatically, and the Fed doesn't have control over that. So at least as of right now, I don't think we should assume that's going to affect things one way or another. Certainly, as we get more information, that could change. As always, if you have any questions, feel free to comment below or call, text, or email me. But thanks for tuning into this video, and I'll see you next time.